Hey everyone out there. Thank you so much for tuning in to another edition of Market Takes here with me, Dion Rabouin, reporter at the Wall Street Journal. We are going through all things markets, everything that's important to the market, and I'm going to be breaking down what you need to be watching out for if you're an investor, if you got a 401k, if you're watching the economy, which really I think all of us should be right now. I'm going to talk about what's going on this week, what to look out for, and how to read that, interpret it, and really kind of navigate through all the important market moving things that we're gonna get this week. This week, to me, when I look out at what we've got coming, the slate of data releases, it's all about the Federal Reserve, all about the Fed. And we are going to learn a lot about what the Fed thinks, what they're doing, and what they've done. And we're also going to get some information about some new data that they'll be looking at and really having to dig and dive deep into as they make their decision on monetary policy in June. That's coming up. So this week, it's all about the Fed. We get the minutes from their last FOMC meeting, which was in May. That's this month's meeting. We get those minutes on Wednesday afternoon. And then on Friday, we will get the PCE, Personal Consumption Expenditures report. That's the Fed's favored measure of inflation. So we get that Friday morning. I think those are going to be very big and very important to the market as we move forward. Now, what we've got right now in the market, if you don't know now, you know it's been a rough couple months really in the market, and particularly rough. As we look out, we finally are starting to see some green today. You've got the Dow up almost 2% as I look onto WSJ.com. The S&P 500 up more than 1.5%, and the NASDAQ up a little bit more than 1% as well. Looking at bonds, you've got the 10-year Treasury yield down some, or up some, excuse me, today. Those bond prices down a little bit. We're seeing oil prices around neutral, really kind of stuck at that $110 a barrel level where it has been for the past couple weeks. Also seeing some moves in gold. We're seeing gold up a little less than 0.5% today, but seeing those moves where the market is, you know, the stock market is finally starting to bounce back. We're starting to see some green, but the big question I think any investor has to be thinking right now is, will this continue? Is this real? Is this what they call a dead cat bounce, where, you know, the market has gone down so much that now it's picking back up just a little bit? Or is this, you know, the start of something consistent? We shall see. Right now, the Dow has been in a losing streak for 8 straight weeks. It's been down every week for 8 straight weeks. That is the longest weekly losing streak since April of 1932. So that tells you the kind of territory that we're in. It's also been down 13 of the past 15 weeks. The S&P 500 and the NASDAQ both on 7-week losing streaks. That is the longest since March of 2001 for both of those. So 1932, 2001, not good years, not what you want to be comparing yourself to when it comes to the stock market if you are a long investor. On the bond side, we're seeing kind of the opposite. We've seen bond prices really start to pick up. The last 3 days of last week, we saw the U.S. Treasury market, bond prices rising, which means those yields were declining. And we saw that, and it looks like we could be moving into a different pattern. We've seen for about the past 2 months or so, stock prices going down and bond prices going down. We're seeing a little bit of divergence for that. Today, you see stock prices going up, bond prices going down, but we've seen kind of the opposite the last couple weeks. Both the 10-year and the 2-year yield both declined 3 of the past 4 weeks. So that's good if you're a bond investor, but if you're just looking at what that means to the economy, generally it means there's some fear in the market. It means investors are a little bit worried about the pace and the growth of the economy. Oil prices up 3 of the last 4 weeks. That's definitely something to watch out for. I was talking to Peter Atwater. He is a professor of economics at William & Mary who specializes in sentiment and sentiment indicators. He says that no one's really watching these oil prices, and I'll quote you what he said. He says, if this continues, there are going to be big problems for the consumer that nobody is even thinking about today. So keep your eye on oil prices. I think that's something that we haven't been talking enough about as we sit at this level over $110 per barrel. So again, what to watch for this week? We get those minutes from the FOMC meeting. That's the Federal Reserve's rate setting committee. When they had their meeting at the beginning of this month, we get the minutes from that, which are going to tell us what they talked about and talk about the meeting. We also get that PCE report on Friday morning. And the sneaky important piece of data that I think everyone needs to watch out for this week, it's the first revision of the US first quarter GDP report. That sounds like a snooze fest, but I'm going to tell you why you need to watch out for that this week. So let's jump right into it. The FOMC meeting minutes are released Wednesday afternoon. I think all eyes from the market are going to be on this. Normally, not a lot of attention gets paid if you're, a highly sophisticated bond investor. This is something you watch. If you're, a private or an asset manager at one of these larger firms, is something you watch. But the average everyday person probably doesn't watch the FOMC minutes. I think that's changing this week, and I think this week will probably be the most watched FOMC minutes in quite some time. Now, what those minutes are, if you are not a regular observer of this or someone who doesn't regularly check in with those FOMC minutes, it really just gives you a bit more granular detail about what was said and what happened at the meeting. Fed Chair Jerome Powell, after the meeting, he comes out, he gives a speech, he talks to the media for half an hour, and you get to find out what the chairman's thinking, what he's hearing, what he believes to be happening with the economy, but you don't hear from anyone else on the Fed. Well, we get the minutes from that meeting and we get to find out, okay, here's what was really said, here's what they really talked about, here's what they really thought. So you get some views from specific members of the Fed. They'll say, a number of members said this, a few members said that, a majority of members felt this way. And savvy investors can really dig through these minutes and find, this could be a trend, this could be the end of a trend, the Fed could be moving in this direction rather than that direction. And I think right now where the Fed is really driving the economy with these rate increases and potentially, putting us on the doorstep of a possible recession, that's something that I think is really going to be very informative for investors and for folks who are watching the economy. Now, like I said, even if you're not managing $10 billion, you probably want to know what's going to be going on with the economy. And one of the reasons I think this particular slate of FOMC minutes is going to be so important and impactful is because there have just been growing recession fears now for some time. We're starting to see communication from the Federal Reserve, from Chair Jerome Powell, that this soft landing that has been, kind of hinted at and suggested that the Federal Reserve could do might not really come to pass. If you remember, a few months ago, Fed Chair Jerome Powell said, we believe that we can engineer a soft landing, and then he kind of moved to, a soft-ish landing, and then recently in comments with the Wall Street Journal and others in the media, he said, we can't guarantee that there will be a soft landing. Essentially, a soft landing means the economy's been kind of soaring through the air like a plane, and now the Fed's got to bring it down by raising those interest rates and slowing down the economy, making it more expensive to borrow money, making businesses kind of pull back on some of the expansion that they're doing, and those sorts of things, which are designed to, they really are designed to slow the economy, which means hiring is going to slow. The Fed Chair Jerome Powell has said himself, he expects the unemployment rate to start to pick up a little bit. A soft landing would mean, we can do all those things without having unemployment really pick up significantly, without having a painful recession. And you're starting to see the Fed back off of that soft landing. We saw at the end of April, Deutsche Bank's economists say, we are expecting not just a recession, which they said earlier, they said now we're expecting the coming recession will be worse than expected. We saw Goldman Sachs senior chairman Lloyd Blankfein come out last week and say there is a very, very high risk of a U.S. recession. We saw former Federal Reserve Chairman Ben Bernanke say that the Fed's slow response to inflation was a, quote, mistake, and that he sees stagflation as likely. Now, both of those things, I want to hit those separately. Stagflation really is a major worry of economists because it means the unemployment rate is going up at the same time as prices keep going up. So for regular folks out there, they have less job security. They could be losing their jobs. That raise that they were hoping to get maybe doesn't happen because business is slowing down at the same time as you've got less job security, maybe less money in your bank account or in your wallet. Prices are still rising at a fast pace. That's stagflation, and that's a major worry for economists like former Fed Chair Ben Bernanke. And the Fed's response to inflation. If we remember last year, the Fed said inflation is transitory, transitory, transitory. And as we moved through the year and inflation just kept picking up and rising faster and faster, we saw that that was incorrect. Towards the end of the year, they said, hey, you know what? We don't think this thing is transitory. We're going to retire that term. and we're going to start taking action. They've started doing that now. We have seen 2 straight meetings with rate increases, and we expect to see the Fed raising rates at more than double time, or at least double time at this meeting in June and at the meeting in July, maybe even pushing out into September. So again, we are talking about what's going on. This is all about the Federal Reserve. This is my live stream. Thank you so much. By the way, this is the #1 live stream on my personal YouTube channel for the Wall Street Journal. So I appreciate you tuning in for that and for being with us. We're talking about the FOMC minutes, why those are important. We get those Wednesday afternoon. And we're going to be talking about the PCE inflation report that comes out Friday morning. So thanks for being with us and appreciate you guys tuning in. Now, the other reason those FOMC minutes are going to be really important is the CPI, which is the other more followed inflation report, really didn't give us a definitive answer on the economy. It was high, but not too high. It was higher than expectations, but still below the number that we got the previous month. So inflation still running above 8% according to the CPI, but slowing down. So maybe we've peaked, but maybe we haven't. There was really a lot of uncertainty from that report, and it suggests that inflation could be stickier than we had previously thought. So definitely something to watch out for when we get this PCE report on Friday, but also the FOMC minutes. How's the Fed thinking about inflation as they went into that meeting? Did they think, okay, well, if PCE and CPI come in below, then we can kind of take our foot off the gas? Or did they think, oh, you know what, even if they're at that 8% level and moving in the direction we want, we've still got a lot more work to do. And we hope, as you know, as folks who are watching the economy, that we'll get some more detail on that. Other big piece of information that we got last week, I talked to you all about housing. Housing prices continued to rise at a very fast pace. Existing home sales rose at about 15% year over year. Also, home builder sentiment was the lowest in 2 years. Again, when we watch those home builder sentiment numbers, it's because we don't have enough supply. There aren't enough houses out there for folks who are buying, and that's what's keeping those prices rising. Well, if home builder sentiment is low, it means they don't see a path to extreme profitability or to increased profitability by building more homes. That sentiment is low for building homes, means less supply likely come into the market. That could mean that prices continue to pick up and rise even higher. Don't forget, I talked to you about this on previous live streams and previous videos I've done. Expectations for economists were for only about 5% growth in housing prices this year. We're at 15 consistently so far this year. Last thing I want to get to is the other thing that we could see in those FOMC minutes is some details about the balance sheet runoff, aka QT, aka quantitative tightening, meaning the Federal Reserve for the past 2 years has been pushing massive amounts of money out into the economy. A lot of that gone into the stock market. Now they're not only stopping that, but they're going to be sucking that money out of the economy, instead of bond buying, they're going to be tightening the economy. So definitely something to watch out for. Last but not least thing I want to make sure and hit is this PCE inflation report we get Friday morning. Will that decline like CPI? Will we see it move down lower than where it was in March, or will it peak higher? CPI and PCE normally move in the same direction, but they are different reports, so we could see different outcomes. Again, PCE measures things differently than CPI. One of the big differences is that PCE is more weighted towards business surveys and CPI is more weighted towards household surveys. Essentially, they call households and regular homes and say, hey, what are you spending? What are you buying? What were the prices that you paid? Whereas PCE is much more focused on businesses. What did you sell? It also reflects different ways of tracking. So PCE tracks, all the prices that are paid. So for example, if with the CPI, right, when you're looking at that report, if you go to your doctor and you have an out-of-pocket cost of $20 last month, and this month it's $25, that'll be reflected in CPI. But if your insurance was paying $50 and now they're paying $60, that won't be tracked into CPI. That is tracked into PCE. So all that to say that PCE could move higher. And if that happens, and rather than PCE having peaked in March, being the highest that it's been in 40 years, that number could go higher. If that number goes higher in April than it was for March, the Fed could be back to square one and have to say, oh my goodness, Inflation is moving even faster than we expected. This prediction that we had that inflation had peaked in March and had gotten as high as it was going to get was incorrect. Well, now we've got to maybe move even faster and do even more to get inflation under control. That would be a really bad sign for the market, and that's why this is a report that I think everyone should be watching. I think it's going to be box office on Friday morning. Make sure you tune in to the PCE release. The sneaky important report for this week, that's that Q1 GDP report, the second or the first revision. It's the second version of it. This is important because we are halfway to a recession. Now, a lot of economists have brushed this off. They say, there's more noise than signal, and that the US economy still is in a good place because that negative figure that we got for Q1 the first time was mostly the result of less growth in inventories and a big trade imbalance, meaning the US bought more from overseas, from other buyers, people like China, the European Union, South America, etc., than they sold to those nations. And that number meant that we actually had a contraction. Growth declined instead of growing in the first quarter. Does that get confirmed? And what happens with that? Basically, the GDP report is just the government goes out and says, hey, how was business? How much did you sell? And they send a report out to, let's call it 100 different businesses. Usually in the first report, they only get reports back from 50 businesses. By the second one, they've heard back from 70. By the third one, they've heard back from 90. So you get a better report and more, a bit more of a detailed look at more businesses when you get that revision. So that's coming out on Thursday morning. Check that because I think it will either confirm or deny this negative path that we're on in terms of GDP. And that's really about it this week. Like I said, I think those FOMC minutes are going to be the big market driver this week. Then you've got the PCE report on Friday, and in between that on Thursday, you'll want to look out for that first quarter GDP, first revision. It's a little nerdy, but if you care about the economy and you want to be ahead of the game, definitely something to watch. Listen, that's going to do it for this live stream. Thank you for tuning in with us. I am Dion Rabouin, reporter for the Wall Street Journal. This is Market Takes. We are going to do it again next Monday at 1:00 p.m. Eastern Time. I hope you'll be there. Don't be and tune in and join in with me, all right? That's going to do it for us here on Market Takes. Thanks for being with us. Let's do it again on Monday.